Hey everyone, welcome back to Corporate Decoder. Today we're diving into Scope SEO semi-annual report, a document that's about as exciting as watching paint dry, unless you enjoy numbers, in which case this is your Super Bowl. So what exactly is Scope RIC LLC up to? Well, they are a management investment company, and this report covers the 6 months ending June 30, 2025. Think of it as a check-in on how their investment game is going. Now, the real juicy stuff is in the schedule of investments. This is where we see where all the money is actually going, and boys, are going into some interesting places. The vast majority of their investments, a whopping 90.56%, are in something called term loans. These are basically loans the company has given out, likely to other businesses, and they spread this across a whole bunch of different companies like AIS Holdco LLC, Apex Service Partners LLC, and Arctic Holdco LLC, Apex Service Partners LLC, and Arctic Holdco LLC. Look here. They've got a loan with AIS Holdco LLC that matures all the way in May 2029. The interest rate is tied to something called CME, term SOFR, which is basically a way to calculate interest that can change depending on market conditions. It's like a variable rate mortgage for businesses. Another example is this loan with Ardenon Midco 3 Limited. This one has a fixed rate of 2.75% plus that CME term SOFR. It's due in February 2031, so they are locking in capital for a long time on some of these. And when you add up all these loans, they call it direct credit. And it totals a massive $522,000, 2016,000, and 22 That's over $500 million just in direct loans to other companies. This tells us SCOPE RIC LLC is heavily involved in lending, probably looking to earn steady income from interest payments. But it's not all loans. They also have a small slice, about 120%, in something called Fund of Funds. Specifically, they invested in something called BCP Great Lakes 2, Series A Holdings LP. This likely means they are investing in other investment funds, which is kind of like investing in a portfolio of portfolios. It's a way to diversify their investment even further. Then there's the short-term investments category, which makes up 3.61% of their holdings. Right now, their biggest short-term holding is a time deposit with JP Morgan Chase & Co. for over $20 million. This is likely a safe place to park cash for a short period, earning a bit of interest while staying liquid. So all these investments together, which cost them over $550 million, are valued at almost the same amount, $549,950, $970. This suggests their investments are holding their value pretty well, as the fair value is very close to the cost. Moving on to the statement of assets and liabilities, we see the overall financial health snapshot. Their total assets are pretty substantial, over $577 million. Interestingly, they have a significant prepayment for investments purchased, listed at over $23 million. This means they've committed to buying more investments but haven't fully funded those purchases yet as of the report date. It's like putting a deposit down on future deals. On the liability side, they have various payables like administration fees, audit fees, and other professional services, totaling just over $1 million. These are the everyday costs of running the company. The bottom line here is their net assets, which stands at an impressive $576,600 and $572. This is the value of the company after all its debts are paid. Looking at how these net assets are made up, you see paid in capital at over $318 million and total distributable earnings at over $258 million. Paid in capital is essentially the money investors have put into the company. Distributable earnings represent the profits that could be given back to investors. Now let's peek at the statement of operations, which shows how they made and spent money during the 6 months. Their main income driver is interest income, bringing in nearly $19 million. This makes sense given their heavy investment in loans. All in all, their total investment income is just under $19.5 million. Pretty solid. But running a company like this isn't free. Their total expenses for the period were about $802,000. This includes legal fees, administration fees, and other operational costs. After subtracting expenses, they ended up with net investment income of over $18.6 million. That's the profit from their core lending and investment activities. They also had a net realized gain on investments of about $413,000, meaning they sold some investments for more than they paid for them. However, they also saw a net change in unrealized appreciation, appreciation on investments of a negative $135 million. Unrealized means the value of investments they still hold has gone down, even if they haven't sold them yet. This is a paper loss, but it affects their total performance. Combining all this, the net increase in net assets resulting from operations for the 6 months was a healthy $17.7 million. The statement of changes in net assets provides a look at how the company's equity has evolved. The net change in net assets resulting from operations is that $17.7 million we just discussed. But notice this, they made distributions to investors totaling over $33.6 million. This is a significant amount of money being paid out to shareholders, which reduces their undistributed earnings. On the flip side, proceeds from shares issued were over $310 million. This shows they've been actively raising capital from new and existing investors. This activity resulted in their net assets growing from about $282 million at the start of the period to over $576 million by the end. That's a massive increase in the company's size and value. And for the shareholders, the net asset value per share decreased slightly from 105 to 6,700, often 82 cents. This isn't necessarily bad. It just means that with all the new shares issued, the total value of the company divided by the number of shares works out to a slightly lower per share value. This is echoed in the financial highlights. The total return for the period was about 4.91%, which isn't annualized. That means that if you invested at the start of the period, your investment grew by that amount if you reinvested any distributions. The total return for the period was a positive 4.91%. Now that's not annualized, so it's the actual return for those 6 months. It's a decent return, especially considering the overall market conditions. Their portfolio turnover rate was 15-50%. This means they bought and sold about 15-50% of their portfolio during the period. For a company that seems to be making long-term loans, this isn't an excessively high turnover rate, suggesting they aren't actively trading in and out of positions very frequently. Now let's dip into the notes to the financial statements, which give us a bit more color. It clarifies that Scope RIC LLC is a Delaware limited liability company and that Hamilton Lane Advisors LLC is their investment advisor. They follow generally accepted accounting principles or GAAP, which is standard. They value their investments at estimated fair value, and when market prices aren't readily available, which is common for private investments, they use various valuation techniques. This is important for many of their investments, especially the private credit loans. They are using level 3 inputs for valuation. This means the prices are based on significant unobservable inputs. Basically, there isn't a readily available market price, so they have to estimate the value using their own assumptions and data. This introduces a higher degree of subjectivity and potential for estimation error. The report also breaks down their assets by valuation level. A massive $522 million in term loans falls into level 3, meaning that value is based on these unobservable inputs. This is the highest risk category for valuation. The reconciliation for level 3 assets shows that at the end of the period, those assets valued using these less observable inputs were worth over $500 million. The report states that for some of these level 3 investments, fair value assets of approximately $313,2033 out of 32 have been excluded from the detailed table about valuation methodologies and inputs because they used unadjusted inputs that have not been internally developed. This is a bit of a red flag, suggesting that a significant portion of their level 3 assets are valued based on external factors, simplified to a point that makes detailed internal analysis less meaningful. Whereas testing one analysis less meaningful, out of 40 assets are valued based on external factors simplified to a point that makes detailed internal analysis less meaningful. For the portion of level 3 assets they do detail, the valuation is based on an income approach, using market yield as the unobservable input, ranging from 8.65% to 10.91%. An increase in this market yield would actually decrease the valuation of these loans, which makes sense. If market yields go up, the value of existing loans with lower fixed interest payments goes down. Under certain risk factors and conflicts of interest, they are very upfront about the risks. They mention that the fund is not diversified and investors shouldn't expect to redeem their shares daily like a mutual fund. In fact, they don't plan to list their shares on an exchange, so there's no easy way to sell them. They explicitly say the fund's investments are generally illiquid, non-publicly traded securities. This means if you want your money back, you might have to wait a very long time, or they might not be able to buy back your shares if too many people ask at once. It also highlights that these investments are not rated, and as such they have been categorized as non-investment grade. This means the loans they've made carry a higher risk of default. Finally, a really interesting detail is in significant shareholder, which says that as of June 30, 2025, the fund has one shareholder holding 100% of its shares. This suggests the report is primarily for one large investor, or perhaps a single feeder fund, rather than a diverse group of public investors. So what does this all tell us? HL's Scope RIC LLC is essentially a lending business disguised as an investment company. They're making a lot of money from interest income, which is great, and they've managed to raise a significant amount of capital. However, their reliance on level 3 valuations for a huge chunk of their assets, combined with the fact that these are primarily unrated and non-investment grade loans, points to a higher risk profile. The illiquidity of their shares also means this is not an investment for anyone needing quick access to their money. The fact that they distribute quite a bit more in capital than they earn in net investment income suggests they might be returning capital than they earn in net investment income suggests they might be returning distributions with operating profits, which is something to watch. Ultimately, they are a large, concentrated bet on private credit with all the potential rewards and risks that entails. Alright, that's our breakdown of HL Scope RIC LLC's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.